Good morning. My name is Pam Calamayo, and I'm an Assistant Vice President, Branch Manager for Chemung Canal Trust Company in Bath, New York. And I've been lending for over 34 years. Today, we're going to talk about refinancing your home mortgage. Like car insurance, you should look at what interest rate you're paying on your current home loan during the course of paying it back to make sure that you're getting the best deal for your needs. Market changes, especially in the last 12 months, have been at historic lows. But how do you determine whether refinancing is a good option for you and your home budget? To begin, you'll need to gather the details on your current loan, including the outstanding principal balance, the rate, and the remaining term, along with how much of your payment is made up of principal, interest, taxes, and insurance. Once you have the information on your current loan, contact some of your local financial institutions to determine what rates and products are being offered, as they can change. Many financial institutions currently have no closing cost products, which are good as they help pay some of the costs that are associated with refinancing a home. Some of these fees are for appraisals, mortgage tax, and the like. This is important as it may allow you to refinance with little to no money out of your pocket. If you do have a current escrow of your taxes and insurance, you will need to have those funds available at closing. Most no closing cost products require that you keep the loan for 36 months, but in the long run may still save you thousands of dollars over the term. Let me give you an example by comparing a loan that is currently at 6% with a 15-year remaining term with a $100,000 principal balance versus a no closing cost product with the same term and the current rate. So currently with the 6% loan, the payment is for principal and interest $843 a month. If you continue on and do nothing with the loan, the interest over the remaining 15 years would be approximately $51,893. Refinancing for the same term with a rate of 3.125% gives us the following information. The payment would decrease to around $696 a month, but the interest, more importantly, would decrease to right around $25,388. This is based on you making your payment for the same day of every month over the term of the loan. So in this difference, the example of savings is over $26,000, which is very significant. Other ways that you can save are to do a biweekly payment, which means that you make half a payment every 14 days. You could also look at shortening the repayment term, which may keep your payment the same, but have additional cost savings. In today's example, and to keep things simple, we have kept with the same term and dollar amount. Once you determine that you want to pursue a refinance, you will also need to gather the following information. Do you have any credit issues that need to be resolved? And that would include past dues, collections, or charge-offs. If you're uncertain where you stand, you can get a free copy of your credit from each of the bureaus at www.annualcreditreport.com. In most home refinances, the maximum loan-to-value, which means how much you want to borrow versus how much your home is worth, is capped at 80%. That is for a stick-built house. If you have a double wide, the loan-to-value maximum may be less. Speaking of value, we all think we know what our house is worth, but how can we actually have an idea of what it's actually worth? You can begin by looking at your county website to see how much your home is being assessed for. Secondly, you can look at the different sites that are available that show property for sale and do a search to see what is actually sold that is similar to your home in the last 12 months. While doing your research to get an idea of your home value, for an actual appraisal will have to be completed when you apply for a refinance. But doing the research will at least give you an idea so there aren't any surprises. Debt to income, which is how much debt you have versus how much income you have, will have to be evaluated and many times will be capped at a certain percent depending on the lending program. Income, which shows your capacity to make your loan payment, needs to be verifiable and can come from many different sources. In the case of a self-employed individual, there needs to be 2 years of federal tax returns with all schedules included. But what happens if you don't qualify for a refinance right now? And that could be for many reasons. Are there other ways to reduce the interest that you're paying? There are. You can make a principal reduction on your current loan at any time. Principal payment means that it does not roll your due date to the next month, but it will reduce the amount of interest that you pay as the actual accrual, which is the daily interest factor, will change. Going back to that $100,000 example at 6%, as a reminder, the payment on that was $843 for the 15-year term with an interest payment of $51,893. If you make an additional $80 a month principal payment, in addition to that $843, you will reduce your repayment term by 24 months and you will decrease the interest that's paid by more than $7,600. Rates on home loans do not lock until after an actual application has completed and can fluctuate daily. Homeowners insurance for the amount of the loan is required and taxes have to be current. While this is not an all-inclusive list of items and processes in a refinance, we hope that you have found this information helpful. Thank you.